Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic income and expenses. In this question, you will learn to interpret the ledger account for transactions on various dates. You will learn to calculate the interest expense correctly for a loan that has been taken sometime during the financial year, and also discuss an accounting theory which justifies the recording of expenses incurred in a financial period. You can see the question on the left hand side, and on the right hand side we've got all the workings which we'll go through step by step. So let's begin. The following accounts are extracted from the books of a law firm for the year ended 31 December 2022. So here you can see we are given the ledger account for legal fee revenues, and we are given the ledger account in the usual 5-column format with the date in the first column, followed by the cross-reference of accounts in the particulars column. Then we've got the columns for debit and credit amounts, and lastly the final balance column. The requirement in Part A is to interpret the transactions that took place on the various dates. So starting with the 1st of Jan 2022. So what really happened on the 1st of Jan 2022? So on the 1st of Jan 2022, we can understand that the business has $20,000 worth of receivables. And this $20,000 worth of receivables relates to transactions done with customers on credit in the previous financial year. So in the previous financial year ending 31 December 2021, the business performed some legal fee services on credit, and the customers still owe that money, which is $20,000, right? So what we are mainly doing here on the 1st of Jan 2022, when we debit the legal fee revenue receivable account in the ledger account for legal fee revenue, is that we are mainly saying $20,000 that is recorded to reverse. That is a key word, all right? So we are reversing it, the legal fee revenue which was earned last financial year but yet to be received this financial year, all right? So in the ledger account for legal fee revenue, we are showing that we have $20,000 worth of fees that were earned in the previous financial year, which are still not yet collected, okay? So you need to make sure those key words which I've highlighted in yellow are there when you interpret this transaction to get full marks. Now let's go to 15 September 2022. So on the 15th of September 2022, we can see that the business provided legal fee services on credit, and the amount is $43,000. So when revenue increases in the business, we always credit it. Okay, so the legal fee revenue account in itself is credited, and simultaneously we would debit the current asset account for trade receivables, because these accounts refer to the credit customers of the business, all right? And these customers owe us money, so we have some economic interest with these customers. Therefore, these customers are classified as our assets, and when assets increase, we would debit it, right? So when the services would have been provided, we would debit trade receivables by $43,000 and credit legal fee revenue by $43,000. So we can just simply state that on the 15th of September 2022, the business provided $43,000 worth of legal fee services on credit. And we have also discussed the relevant journal entry. Although we are not required to do it, we would be debiting the trade receivables account by $43,000, which would be to increase the assets we have got in our business, and simultaneously credit the account for legal fee revenue by $43,000, because every time the business earns any kind of revenue, we always credit it, okay? So legal fee revenue account would be simultaneously credited by $43,000. So I'm showing you the journal entries just in case you're curious and you love accounting like me. All right, so now let's go to the third transaction, which is the 31st of December 2022. So on the 31st of December 2022, we can see that the business is recording some kind of adjustments, all right? So the first adjustment, which is mainly what we are talking about, is the legal fee revenue received in advance that is being debited in the legal fee revenue account by $11,000. What does this mean? So when we have revenues received in advance, we have a current liability now, all right? And because we have a current liability, within the revenue account, we can't show this revenue as something that we have already earned because we have no right to say that we have earned this revenue because we haven't performed the services or delivered on our promises in this current financial year, but we would be delivering on the services in the next financial year, all right? So basically that is what you need to write. The key word here is adjustment. So adjustment that the business recorded for receiving $11,000 worth of legal fees in advance in this financial year, which is a current liability, right? As we can understand, because you have taken the money, you haven't delivered on your promises this financial year, right? For services to be performed and earned in the next financial year. So you're going to deliver on your services in the next financial year. But when you are preparing the books at 31st of December 2022, you would be showing this as legal fee received in advance, which is a current liability, and this is not really counted as part of the total revenue earned during this financial year, okay? All right, so what about part B? State the effect on profit for the year if item 3 was not adjusted on 31st of December 2022. So it's referring to this transaction, right, which we have just interpreted. So as we have already discussed, if we hadn't shown this as a current liability, we would be including this in our revenue, which would be a mistake. That means our revenues would be overstated and profits would therefore be also overstated. So therefore the profits would be overstated by $11,000. So let's look into part C. On the 1st of April 2022, the law firm obtained a loan of $180,000 from a bank. The principal is repayable over 5 years. So the principal is referring to this original amount of $180,000, which you're going to repay over 5 years in equal installments. There is also some cost to getting this loan for the law firm, which is to pay interest at 6% per annum, which means the law firm is incurring an expense. Both the loan and interest are repayable each year on 31st of March. So basically the loan was taken on 1 April 2022. So every 12 months would be ending on 31 March of the next financial year, okay? But the business has their own books, which is the financial year they record, and that is 31 December every year, all right? So the requirement is to calculate the interest expense incurred for the years ended 31 December 2022. So what is the business going to show in their books? So let's understand what's going on step by step. We understand the loan was taken on the 1st of April 2022. And the business is preparing the financial statements and the books on the 31st of December 2022. So from the 1st of April 2022 until the end of 31st of December 2022, we have got 9 months in total. And we are interested in finding the interest expense incurred for these 9 months, which we want to show in our books at 31 December 2022. So we understand the original loan amount is $180,000. So therefore the interest expense can be calculated by taking the annualized interest rate of 6%, multiply it with the loan amount of $180,000, and then multiply it with 9 over 12, which basically converts the 6% annualized rate into a 9-month rate, okay? And that gives us an interest expense of $8,100 for the 9 months this loan was used in the business, okay? So that is the answer for finding the interest expense incurred for the year ended 31 December 2022. Next, we are required to prepare a statement of financial position as at 31st of December 2022 and show the amount of loan outstanding and interest expense payable. All right, so we know based on the facts given to us that we are going to repay the loan over 5 years. So if the loan amount is $180,000, so every year we're going to repay $36,000. So we just simply divide 180,000 by 5. Given that today we are at 31st of December 2022, And this is the day where we are preparing our books and the financial statements, which are the income statements and the balance sheet, right? We have to show what's going on. So we understand because the next repayment is at 31 March 2023, which is this $36,000 that you're going to repay, right? When we are preparing the books at 31st of December 2022, we have to show this as a current liability, which basically mentions the fact that when you do the balance sheet at 31 December 2022, make sure you record the present obligation of $36,000, which is due for repayment in the next 3 months and requires your attention, okay? So when you prepare the extract of the business, we will show the extract in 2 sections, non-current liabilities and current liabilities, and you'll understand why. Firstly, we understand that at 31 December 2022, we know that we're well aware that in 3 months' time, on the 31st of March 2023, $36,000 of loan is repayment. Therefore, we can classify that as a current liability because the definition of a current liability is that it is a present obligation which needs to be taken care of within the next 12 months, right? So therefore, in the current liabilities section, you can show the current portion of the long-term debt, which is $36,000 that is due at 31st of December 2022. Then you show the interest expense payable of $8,100 because we calculated the amount to be $8,100 at 31 December 2022. But it's just an expense which has been incurred and the business still didn't pay for it using cash because the payment is only once, and that is going to be on the 31st of March next year, right? So when we do 31 December 2022, this is a current liability. So you show interest expense payable of $8,100 as a current liability. And also in the non-current liabilities section, if the short-term repayment is $36,000, then the long-term debt that still remains is $144,000, and this debt is to be paid off after 12 months, so which is a long time, right? So therefore, you can confidently classify the remainder $144 as a non-current liability. Okay, so next question, the last question, state the accounting theory that we have applied for interest expense. So let's discuss 2 theories, starting with the accrual theory. Now, the accrual theory simply states that revenues are to be recorded as they are earned, not necessarily when you receive the cash, and expenses are to be recorded as they're incurred, not necessarily when cash is paid. So obviously that is what we have experienced in this question for interest expense that we have incurred for the 9 months ending 31 December 2022 to be $8,100, and we are well aware that it is a current liability at 31 December 2022 because we haven't paid for it using cash, all right? So just because we haven't paid for it using cash doesn't mean it is not an expense that has not been incurred. So we have obviously justified why we record interest expense incurred using the accrual theory. What about using the matching theory? So basically, when we find profit, we all know that. So profit simply is basically all revenue minus all expenses, right? So we know that. And therefore, as part of the expenses, we have got interest expense, which we have incurred for the financial year, right? The cost of taking the loan from DDS Bank, because obviously DDS Bank is not going to give you the loan for free. They're going to make money from you. And that money that they're going to make from you is the interest expense which you have to incur, right? So this interest expense incurred must be matched against the revenue generated from using the loan in the same financial period for accurate profit calculation. When you're running a business, if you are entering into a long-term loan arrangement of $180,000, it better be for good use. And that good use is obviously to help you generate more revenue in the business, right? So obviously, what we want to do is we want to match the interest expense that we will incur in a given financial year against the revenue that we will generate by using the loan in our business operations. So that way we can determine an accurate profit, okay? So you could talk about either of these 2 theories and definitely you'll get full marks, all right? Okay, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And be sure to check the links in the description for the courses that I'm running. And I'll see you in the next lesson.